Awesome. Perfect. I'm gonna let you roll it.
I'm a little shy, so could you speak for me?
Yeah, so I can teach us.
All right, welcome. Good morning. Oh, can everyone hear me okay? Because I think this thing's off. Let's see. How about 1, 2, 3? Is it on now? 1, 2. Should I have it on or off?
You
On.
can hear it back here. So
What?
It sounds like you don't have it on, but back here, we can hear you now.
Okay.
Cool
I'll
now.
just start whispering.
All
All right. So welcome all to the first ever Alcoholics Anonymous class. We have rum and Coke in the back. And if you're here for something else, good. All right, I'm in comedy school and sometimes I fall on my face, so just appreciate the laughter whenever possible. In all seriousness, let's get started. One thing I like to do is start on time and end on time. And if we can end a couple minutes early, I will. We have a 10-minute break in 50 minutes, so that's good. So hold your coffee breaks or restroom breaks, or I guess your soda breaks over that way. The rum is not in the building, but we can deal. I'm recording myself, not going to record you guys. Feel free to be as talkative as you want. The way I like to do my classes, I've been doing this for 16 years, by the way. I've been in the industry for 26 years, but I've been teaching these classes for 16. Ask me anything while I'm doing the presentation. When I come to a period, I'll answer your question, and let's just keep rocking and rolling. On a rare occasion, while I say, a slide's coming up, hold on. But most time, I'll just go ahead and answer the question, and when the slide comes up, I'll just fast forward. There's going to be a bunch of slides I'm going to fast forward, because this is actually a 3-hour class. I shrunk it. So, you're going to learn all you need to know in 2 hours, and it's all about you making more commission. It's also about your clients getting a heck of a deal on buying a home, the retirement home. So we're going to discuss both. In fact, we're going to discuss several things more. We're going to start off with understanding the HECM. Some people call it a reverse mortgage, and that's fine, but I'm going to teach you why you shouldn't use that word reverse mortgage. A little bit about me, first of all, is I've been in the industry, as I mentioned, 26 years, exclusively in the reverse mortgage business. I know this product like the back of my hand, and if you are a naysayer or you have some clients that are naysayers about reverse mortgages, throw them at me. You cannot trip me up because I believe in this product with all my heart. It is absolutely the safest loan in the U.S. And I'm going to say that multiple times, and I'm going to prove it to you. I am a certified reverse mortgage professional, a CRMP, and if I can be so bold to say I'm an expert of experts, there's only 200 of us with this designation in the entire United States. It's very hard to get this designation, and I was honored to be awarded this designation about 10 years ago. I'm also a certified HECM specialist, which is the legal name of the reverse mortgage. And I'm a certified senior advisor and have been for 27 years. And what does certified senior advisor mean? Nothing. Nothing. And I thank you for laughing, appreciate that. The reason I say it's nothing is, you can go to college and become a lawyer, a CPA, right? A dentist. And a certified senior advisor doesn't make me an expert in anything, but it gives me a little bit of everything. I know a little bit about trusts, Medicare, Medicaid, financial planning, end of life, long-term care, assisted living. So I know a little bit about everything. So when I'm talking to a senior, I can relate to some of their issues. Right? I can understand that there's a sandwich generation, that there's older people, there's younger people. There's some people that I've met that are 95 years old and act like they're 65 years old. And others are 65 and they act like they're 105. All right? We all age differently. And sometimes it's genes and sometimes it's not. So let's get started. You ready to get started?
Sure. Yeah. Yes.
What the heck is a HECM? Home equity, we know what that is. Home equity, conversion, mortgage. And we all know what a mortgage is. Now I'm going to start off with the very basics, and I'm not intending to talk about someone's intelligence, but it's interesting that the word mortgage sometimes can be confusing. A mortgage, it's a loan, right? To keep it simple, you want to buy a house, so you go down to your local bank and you get a loan to buy the house. Or they call that a mortgage. You can call it a loan if you want, but it's called a mortgage because it's attached to real estate. And you can call that a VA loan, a USDA, an FHA conventional. You can call that what you want to call it. But at the end of the day, it's where the bank puts a lien against the house that you buy, and then you make payments for 30 years. Fair enough? That's a mortgage in the simplest of terms. That's a mortgage. So I like to say that a mortgage is a mortgage is a mortgage. Call it a reverse mortgage, call it a conventional mortgage, call it what you want to. But at the end of the day, it's where a lender places a lien against an asset that you own. Now, the question of the day that even real estate agents get wrong, if I'm a veteran, and I am, and I buy a house with 100% VA financing, I put nothing down. I finance 100%. This is a trick question, so don't answer it. It's not a trick question, but don't answer it anyways. If I finance 100% and I put nothing down, I have no equity in it. The day I close, don't answer this, who owns the house, me or the bank? I own the house. There's no equity in the house, but I own the house. I have title to it. And as an owner of the house, I pay the property taxes, the homeowner's insurance, the HOA, the maintenance. If I were to sell it the very next day for a profit, who gets the profit?
You do.
Right. So if you think about that, because everyone gets it wrong, that's why I said don't answer it, is if I sell it for a profit, then I make money. And as owner of the house, to prove that I own the house, I pay the property taxes, right? If I sell it for a loss the next day, then the bank's gonna come after me because they have a secured interest in the property. So when someone wants to take the reverse mortgage word and they want to, well, that's the loan of last resort. Don't ever do a reverse mortgage. Don't ever. You're going to disinherit your kids. You're going to give up your rights. You will never be able to sell it. You'll never be able to move. All the things that are not true. Remember, this is just a mortgage with no payments, or payments are optional. Well, but I can't sell it. Why not? It's just a mortgage. You pay it off. Well, I won't be able to leave it to my kids. Well, why not? You put it in your will. The kids get the house. Now, there's a mortgage attached to it, so the kids get the house along with the lien. Fair enough. You know, I have a mortgage on my house. I'm not quite 62 yet, so I have a mortgage on my house. But if I were to, knock on wood here, pass away on the way home, did I tell you I live in California? Arizona? That's a joke. Anyways, if I were to not make it home, you know, my kids will inherit, well, my wife will, but my kids will inherit my house, and then they've got to figure out how to pay off the mortgage, because it's not their mortgage. It's my mortgage. They got to pay off my house if they want to keep it. Otherwise, what do kids do with the house?
Sell it.
And why do they sell it? Because there's usually 2 kids, 3 kids, and 1 house. And they live in Wisconsin. What are they going to do with the Florida house? They're going to sell it and split the money up because the kids want the money. No matter what your clients say, well, I want to leave my house for my kids. If you ask the kids, oh, we don't want the house, just send us the money. Sell the house for whatever you can sell it for and send us the money. Fair?
Yes.
All right, let's move on. Look, time's up. We got to go. Now, I'm not going to bore you with history, but I'm going to anyways because it helps to understand why there's such bad press over reverse mortgages. Why this program has been around for 35, well, under the federal government for 35 years. So why do people fear it? Why do people hate it? Let's start with 1961. You know what I like? Because I can read that screen without even looking at the screen. This is a cool conference room. Pretend that it's like a teleprompter. In any case, I like this. This is a great idea. In 1961, the story goes that Nellie Young in Maine went to her local bank. Her husband had just died. It was a small town in Maine, and he was very popular. But she's a woman with low income, and basically, forget about credit if you're a woman. And fair enough, that's just the way things were back in the 60s. And she's living on less income than she was. What does she do? She owns a house. Now back then, houses were paid for by the time retirement comes around. Not so much anymore. So she went to her local banker and said, I need some money. The bank said, sorry, can't help you. Remember, small town, loved, her husband was very loved in the community. So they worked out a deal. When we die, there's nothing going with us. If we're a trillionaire, well, we're not taking it with us. If we're a millionaire, we're not taking this with us. If we're in debt, my grandfather used to joke, the last thing I want to do is write a check that bounces before I die. Right? Why not? So she worked out a deal with the banker and said, look, if I give you my house and you allow me to stay there, will you give me some money for it? That's a reverse mortgage. It wasn't called that back then, but that's a reverse mortgage. And perhaps that's where the reputation came from, that if you do a reverse mortgage, you're going to lose your house. Because Nellie Young lost her house. Or did she? She had enough money to sustain her for the rest of her life. And when she passed on, who cares? Who cares? What matters is cash and cash flow in your lifetime. What was interesting is this took some national attention, which is a good thing. UCLA professor got involved, did some actuaries, the US Congress got involved, and decided that we need to do something that can provide some kind of extended Social Security that doesn't hurt our seniors. We can't have predatory lenders, can't have companies taking advantage of our senior citizens. Is it possible to take this wonderful program and housing annuity and turn it into some kind of a federal government insured program under the HUD, Housing and Urban Development, under the FHA umbrella? So they did. 1988, Ronald Reagan signed it into law. If you do the math, that's 36 years ago. Been around for a long time. It was only a refinance program back then, and it took a number of years before it took hold. It wasn't until about 2000, so what is that, 12 years later, before it started getting some really good media attention. Except it got bad media attention. It was a dangerous product. People fear what they don't understand. Fair?
True.
People fear. And bad news travels first. And certainly there was stories out there where someone lost their house. Certainly there was bad stories. Certainly there was, this is an oddball loan. What do you mean you don't have to make a mortgage payment? That doesn't make sense. Reverse? Backwards? I don't know. So people started making stuff up. But remember, this is under the Federal Housing Administration. This immediately became the safest loan in America. We're going to get into the non-recourse feature in a little bit, and that's what makes it the safest loan. So the very first HECM refinance was closed in 1989. And what's interesting is, again, I've been in the business 26 years, but I was the regional manager for the Southeast, and one of my employees who was in his 80s wrote, application-wise, wrote the very first reverse mortgage in the nation way back in the day. Now, he didn't have the honor of closing the first loan in the U.S., but he wrote the first app. He said it was such a new program back in '88, I think he wrote it, that there was no paperwork. There was no guidelines, there was no policy. He took a regular loan application and filled it out and just added the stuff that you would normally add to a regular mortgage and submitted it to HUD. It took him over a year before he finally got it closed. And meanwhile, some lender out in the Midwest was able to write one and get it closed. So he didn't have that honor, but he worked for me. He was in his 80s. He owned a company before me called International Mortgage. So he mostly dealt with oddball loans, mostly foreign nationals. And feel free to ask questions. In fact, requirement, everyone has to ask a question. How's that? There we go, got one.
Well, basically, it's a collateral loan.
Yes, yeah,
You know, bottom line,
yes. And okay, we're done.
that's it.
That's exactly right. There's a lien against the property. It's a collateral loan, absolutely.
Yeah, I saw a lot of businesses, so
Yeah,
where's your collateral?
there you go. That sums it all up. So this class is mostly keyword, about the FHA HECM for home purchase. Okay, so we're going to talk about the refinance a little bit. But at the end of the day, as a refinance is where you already own the property and you're pulling money from it, right? And the payments are optional because it's a reverse mortgage, it's a HECM. A purchase is the opposite of that. It's a reverse of a reverse, where you're putting money into a house, a down payment, and then financing the difference, right? So if you think about it, it's the same program, right? A refinance, you already own the house, you're pulling money from it. A purchase is where you're just putting money into a house and then you own it. It's the same program. The same loan to value, the same numbers,
Oh,
it's just in reverse.
the same?
It's the same program, except with the purchase program, you have to have a large down payment. It's not 3.5% down, 5%, 20%. Heck, it's not even 50%. It's more like 65% down. It's basically a cash transaction. You're putting your clients are putting a large amount of money down. The advantage they get, two advantages that I can think of. One is they're not paying 100% cash, which means they're saving some of their money for retirement, and they don't have a mortgage payment. They're like buying a house for cash, they don't have a mortgage payment. They're putting less money down to buy a nicer house and not having a mortgage payment. It's a good deal. I've had people come to me and say, well, I've got my 5% down. Well, you're not doing this program. Okay, this requires a very large down payment. But how many people here do business with cash buyers? Hopefully everyone raises your hand. We're dealing with seniors, right? The minimum age for this program is 62. Most people that are 62 have more money than someone who's 32, right? They typically have a lifetime worth of earnings. They typically have already owned a home somewhere else that has grown in value. They sell it, they get a chunk of change. They come to Florida, or they're moving, right-sizing their retirement home in Florida, and they have a chunk of cash. Nobody wants to give up all their cash, but they're willing to give up all their cash, or most of their cash, in order not to have a mortgage payment for the rest of their life.
So you're saying that they only have to put down 65% of that loan,
Correct. Of the purchase price.
of the purchase price?
Everyone hear a question? I'll repeat it if you need
And so
to.
is that 65% like a certain amount of years that it's good for? Is that,
Forever. It's good forever. It's a one-time down payment.
and then there's no mortgage payment like after 10 years or
No,
something?
no more mortgage payments. For life. And life could be 30 years, 40 years, 50 years, right? Life could be as long as life is. Now, and 65%, by the way, is just a round number, because there's different factors that go in there. What is the interest rate? What is the person's age? An 85-year-old puts down less than a 65-year-old because their life expectancy is shorter.
Right.
So we'll get into those numbers in a little bit. Question?
I think that this would be a great thing for many of my buyers, but to make sure that I convey the information correctly, what would be the best, do you have a brochure or something that to give it to them so they get the complete and correct information rather
Yeah.
than to hearing from me, which
So-
would be.
Let's come back to that question towards the end,
Okay.
because that is probably the most powerful question you can ask. And I think that over the next hour, I think that we'll make that clear. Because everybody has unique situations. There's people that have some credit issues, right? And we can do those loans. Some serious credit issues, and we can still do those loans. We have other people that have an 850 credit score, the money is good, and they could pay cash 10 times over for whatever they're buying. So everyone has their own situation, but we're going to address that.
So if I understand that correctly so far, if I have a buyer who can afford to pay 65% of the purchase price, they can buy it and don't have to pay mortgage for the rest of their life. However, at the time that they pass on, the house will go to the bank and not to their, that's the main difference, right?
No.
No.
The house goes to their kids or wherever they want the house to go. We're just a bank that lends money. When I say we, FHA guarantees the bank that lends the money. It's just a loan. It's just a mortgage. Nothing changes. The right of transfer still happens just like a regular mortgage. Did everyone hear her statement, question? Again, if some people talk quietly, and so if I need to repeat it, please let me know and I'll be more than happy to repeat it. Question, sir?
So if I buy a house for $1 million, I put $650,000 down, the loan's $350,000. I keel over a week from now. What is the payoff of that loan to my heirs?
Yeah, whatever has been borrowed, plus the interest that's accumulated for that time.
Plus
And
the interest. that
approximate
is-
interest
Yeah, it is a
rate,
loan.
Any other fees, any other,
No, there's
uh,
no additional fees. There's no prepayment penalties. There's no additional fees. So we're all in the real estate business. So if your client's going to buy a house, and let's just keep it simple, they're going to buy a house with a mortgage, a regular mortgage. They're going to have closing costs, right? So they may put down X number of dollars, and they're going to borrow X number of dollars. Chances are they're going to finance all or some of those closing costs. So their initial balance is going to be whatever they borrow plus the closing cost. Now with the regular mortgage, they're making interest payments plus a little bit of principal, a little bit. And they're going to do that for 30 years. And ideally, in 30 years, their house is paid for in a perfect world. In our option, in our program, remember, this is a mortgage. Mortgages have an interest rate. Interest rate's 6.5%, very reasonable. And if a person does not make a mortgage payment, and they're given the opportunity every month to make a mortgage payment on this loan, they're going to get a monthly statement. This is not a bill. interest this much is this month is this much money. Pay it or don't pay it. If they don't pay it, they keep the money in their bank account. If they do pay it, they're paying down the mortgage balance, right? If they don't pay it, the next month they're going to owe more than they did last month, but they'll have more in their bank account. Do you want more equity before you die, or do you want more in your bank account so you can enjoy life before you pass on, right? And that's a personal decision based on a person's own financial goals. Go ahead.
So just to add on to that, and I know you'll probably get to it, but because we're talking about it right now, the interest is accumulative.
If a payment's not made, then the interest accumulates.
It's not made, so it's like an interest only loan.
It's a
But
well, there's no payments, but yeah, it's a
if you choose to.
let's call it a interest deferred loan.
Okay.
Yeah. Now, let's go back. I'm getting way ahead of myself, which is a good thing.
Sorry.
All right. The reason some people will say, well, 65% down, that's a lot. Yes, it is. That means when a person purchases a home using an FHA HECM for home purchase, there's 65% equity from the get-go. There's already a ton of equity. There's more than 50% equity. There's lots of equity. They're only borrowing 35%. Homes increase in value in Florida approximately how much per year, except right now?
Yeah.
On 4%, right? The national average is 4%. I think Florida's a little higher, but the national average is 4%. Which means that if a person buys, let's use simple math, a $500,000 house. Is that fair? Maybe a little bit high, but a $500,000 house, good round number. 4% of $500,000 is $20,000. So if a house increases at $20,000 a year, then the house next year is worth $520,000, right? And not doing compounding because, I got a 3rd grade education, or was it 4th grade? In any case, then next year it's worth $540,000, and then $560,000 and $580,000, right? I'm not counting compounding. So it's worth more in the future. If they're only borrowing 35% of a $500,000 is $175,000. Get your calculator out, do the math, that's what it is. $175,000 is all they're borrowing on a $500,000 house. Their interest is accumulating on the $175,000. So if interest rates are 6.5%, here's where I get in trouble. That's approximately $12,000 a year. Do not get your calculators out for that. Their interest is accumulating by $12,000 a year, but their home value is increasing at $20,000 a year. Which means there's always going to be more equity in this house that they bought with a HECM and they have no payments than they have yesterday. Now, there's exceptions. How many people were in the real estate business in 2009, 10, 11? How many people in the real estate business right now where homes have actually come down a little bit this year? All right, so there's always exceptions. There's always exceptions that houses do go down in value. There's always people that live a long time, and they wind up having this compounding of interest for 15, 20, 25 years, 30 years. So is it possible that there's ever a situation where the house is upside down? The loan balance exceeds the value of the house? Absolutely. There's a non-recourse feature tied into this loan, and we're going to get into that. And that's what makes this loan the safest mortgage in the United States. You cannot be hurt by this loan. So when someone says this is a very dangerous loan, right away, they have no clue how this program works. And you can just take that right to the bank.
So is the interest rate on this loan the same as if I did an FHA loan, 3% down?
No.
How much higher is it?
This
on
is
that?
lower.
Oh,
Yeah, interest rates right now are running closer to 7%, but we're more at 6.5%. So we're a little bit lower. But the difference is a regular mortgage has a monthly payment, and this loan has no monthly payments. So it's a trade-off. And some people want to make payments. That's why I like to use the word optional payments, no required payments.
So it's $175,000 plus the $12,000 every year
Correct. If they don't make a payment.
if they don't make a payment.
Right.
What's the terms? Is it the standard 30-year or is it
Lifetime.
just a lifetime?
Yeah. If a person lives 1 week, well, that's the lifetime. If they live 55 years, 60 years, well, that's the lifetime. Now, if you read the contract, it's this thick.
Yeah, I'm sure.
If you read the contract, there is a due date on this thing. It's your age 150. You have to put a date on it because there's no way to do an amortization schedule. There's no way to do the calculations unless there's an end date. And so far, In the history of the world, no one's ever lived to 150. But it's in there because it is possible that one day there'll be a lot of medical breakthrough. And on that subject, which is not part of the presentation, life expectancy in 1850, right, 47 years old.
Wow.
Now, George Washington lived to 62. Jefferson, Adams lived to 82. There was people lived to 100 back then. But life expectancy was, 1850 was 39 years old, 39.
Wow.
In 1900, the number one killer was the flu in the US. 1900, life expectancy was 47. Now, you're all sitting down for the greatest Ponzi scheme of the world, at least of the United States. In 1935, when Social Security was passed into law, life expectancy was between 62 and 65.
Wow.
And when did Social Security start? Right? So part of that's a joke, of course, but, or is it? Life expectancy today, depending on who you listen to, is 75, 77. However, statistics can be made up on the spot and they can be manipulated. 25% of us will not see age 65. 25% of us will get killed by a car accident, by cancer, whatever. COVID. So if you eliminate the people that don't make it to 65 and just look at the people that make it to 65, life expectancy is actually more like 85, 87. And if you go with statistics, if you make it to 85, you're likely to see 92. If you make it to 92, you're likely to see 96. And we can keep going forever, by the way, because statistics will let you do that. All right, reverse mortgages. It's a general term. It's sort of like, well, a dog. If I was a breeder and I had poodles for sale, little cute guys, they could be big, I guess, but, or if I had a guard dog, a Rottweiler or a German Shepherd, they're all dogs. But what am I breeding? What am I selling? Am I selling a lap dog or am I selling something that's vicious? So I implore you to get the word reverse out of your language, because you're offering poodles. If you want to do a different analogy, how about strawberries? You could have a strawberry stand in Plant City, or do you have a fruit stand? Are you selling lemons and limes, or are you selling strawberries? So call this program what it is. It's a home equity conversion mortgage. Now, good news, bad news. No one knows what the heck a HECM is, which means they'll listen to you. If you say, well, I can help you buy a house with a reverse mortgage, not interested. Yeah, but no, I'm not interested. I can find another realtor right now. I'm not interested in a reverse mortgage, and if you keep talking about it, I'll just move on. Yeah, but if you understand, no, I'm not talking about it. It's a HECM. Well, what's a HECM? Well, it's a home equity conversion mortgage. It has optional monthly mortgage payments. I don't like the word no monthly mortgage payments, because no means no. You can't do it. Optional, not required, is more of a softer word, and it's more true, because if your clients send in a check to the servicer of this loan, they're going to accept it, and they're going to pay down the mortgage balance. And there's another perk that will come up too that actually adds to a line of credit, but we'll cover that later. This is the best, most flexible retirement mortgage on the planet, definitely in America.
Is there a way to change from the existing mortgage to this mortgage?
Yeah, you can.
Because I have a buyer, like 2 years ago with the VA, she bought a new construction house,
Yep.
no down payment, and now she realizes that she has a hard time with keeping up with all the
Yeah.
payments and taxes. So if it would be possible, and selling, she would have to pay for it, because
Right.
she wouldn't. So if it would be possible to switch the kind of mortgage, that might be a lifesaver for her.
So just in case you didn't hear, is it possible that a person who already has a house, in this case 2 years ago, is it possible to switch the mortgage around? The answer is refinance. Yes. If your client yesterday closed on the house and then found out today that there's this HECM for home purchase, well, she's already closed on that loan, but she could refinance with a HECM and pay off that existing loan. It's a refinance. Pay off that existing loan. Obviously, she'd have to come to the table with money if she only put 3.5% down, but she could eliminate the monthly payment for the rest of her life. And depending on when she bought the house, you said 2 years ago, but how about people who bought a house in 2001, 2002, when homes, early days of COVID, homes were pretty reasonably priced. but they went up in value since, sometimes double. And just in the last couple of years, some houses have really gone up in value to the point where they're not affordable. And then of course interest rates went up a lot too. So there's always a chance for someone who bought a house 5 years ago that their house has gone up so much in value that they're able to do this loan with very little money out of their pocket. But yes, the answer is refinance. Okay, I'm gonna keep moving unless someone raises their hand because we have 2 hours.
You have to have money to refinance a house.
No. So
Still the equity in the house you can use to refinance it.
yeah, so let me give you a real life example. Let's go back to the $500,000 house, just because it's a good round number. You have a client that has a $500,000 house, and let's say they're 65 years old, and let's say they have a $100,000 current mortgage. In other words, they have a lot of equity. They owe $100,000, and they like this idea. They don't want to sell and move. They just want to eliminate a mortgage payment. We can, based on that person's age, we can lend them perhaps $200,000. The first $100,000 is going to eliminate that mortgage, which means the difference, $100,000, can go to them.
Okay.
Either in a lump sum, in a line of credit, in monthly installments, just like Social Security, mix and match. We'll get into the options later, but it's their money. It's not taxable. I wouldn't call it free because it's their money already. It's home equity. But we have to pay off any existing liens, but the difference between what's available and what their liens are, their mortgage is theirs to do what they want to with, no strings attached. And again, no income taxes. Okay, so a little bit of history. The HECM for home purchase during the housing recession was introduced by Congress. We've been talking about it for a long time, but this has always been a refinance program. You had to already own a house in order to do a HECM. And there was people, just like your client, that wanted to buy a house but couldn't because the program wasn't available. So they would pay cash for a house or maybe finance it, and then the day after they closed on the purchase, they immediately refinanced it to get their money back. The problem with that is there was 2 closings, and we all know how expensive closings are in Florida. You have a lot of intangible tax, doc stamps, title insurance. There's a lot of costs. Florida is one of the most expensive states to do mortgages in. But we don't have an income tax, and maybe not a property tax in the future. Who knows? So in 2008, HUD, it was introduced to HUD to maybe revamp the program and turn it into a purchase program as well as a refinance to stimulate the economy. So it was passed into law. They introduced it in 2009 officially, and the program didn't have the bugs worked out, and some people got really good deals. Good for them. But in 2010 is when the program really got started. That's when I was able to do my first loan as a purchase. And the bugs were worked out, and it just improved ever since. So it's been around for 16, maybe 17 years, a long time. How many people in this room, please raise your hand, up until recently even know this program existed? Did not know this program existed. Right, so half the room. What's interesting, according to NAR, only 3% of real estate agents know about this program. 3% across the nation. We're in Florida. It should be 50%, it should be 80%. We're missing the boat. Missing the boat. Florida happens to be the #2 state for this kind of a loan, California being #1. But this loan is very popular for those who are in the know. And everyone in this room is now in the know, which means that you can beat out your competition. If you want to own a 55+ community, if you want to own an area that has mostly retirees, become an expert at this, because you're offering something that nobody else offers, except for 3% of real estate agents. So, yes,
You said we can offer, of course, we can just tell them about it.
yes.
How do we benefit? How do we benefit?
What?
As a realtor?
What? Benefit? What? What?
You got a sale.
Well,
Of what? Of the full
Yes,
purchase price
so-
of the house, or the leftover 175,000?
no, the full value of the house. I'm gonna give you a couple of answers, maybe 3 if I can do the math right. So first of all, unless you're a licensed mortgage, you can't get any commission from the mortgage. And unless I'm licensed real estate, which I'm not, I can't get any commission for the real estate. So you have your world, I have my world. you benefit in several ways. One is you're getting a sale, not just a sale, but probably a sale on a house that you're selling for more than what you would have otherwise. For example, someone comes to you and says, I've got $300,000 cash money. I want to buy a house. And the first thing in your mind, go ahead and answer this question. The first thing in your mind is what is the first thing in your mind?
How old are you?
And the second thing is, where are you going to sell a house? Now, what they want is they want the golf course, and they want the conservation view, maybe not too far from the beach, and they want a swimming pool and a jacuzzi.
Not for 300,000.
And a gated community.
Not for 300,000.
But that's what they want.
Right.
So then you remember this program here. And based on their age, maybe they qualify for a $500,000 house for the same $300,000 down. And no mortgage payment. Now you just sold them a $500,000 house, increased your commission quite a bit. They're happy because they have no monthly mortgage payments for the rest of their life. Their house is going to increase at a larger amount, percentage-wise, every year, not percentage-wise, but dollar-wise, than they would if they bought a $300,000 house. They want what they want. And a $300,000 house is nice, but a $500,000 house is nicer. And your commission is based on the $500,000 purchase price, regardless what the loan is. And if they happen to be local, maybe they're in a 2-story house, or maybe a house that's not in the best of neighborhood, and you show them the good neighborhood or the better house, perhaps you get a listing and a sale. All because of this program. There's lots of ways to make money. How about this? This is at the end of the presentation, I'll tell you now. This program works for duplexes, triplexes, and quadplexes. If they live in one of the units, they can rent out the others. And that's their money. It's their money. Now they finance the whole project, all 4 units, 3 units, under the HECM. As long as they live in one, they can rent out the other. Talk about net worth increasing and talk about cash flow. Right? $1 million property, put down $600,000, finance the other $400,000, have no mortgage payments, and have 3 rental units. Right?
So, if you have an 85-year-old person that owns their home, free and clear, and they need to go to a nursing home, but the adult son lives there, can they do the HECM refinance to pull cash out to pay for the nursing home and leave the son in the house?
This is why I'm a certified senior advisor, because I know a little bit about everything.
So, when mom passes away, son has no money.
Right, so
What happens?
here's the rules. Okay? I'm gonna digress just for a moment. Anybody who feels they're pretty knowledgeable about FHA financing, just clear your head. This is under the FHA umbrella, but it has a whole different set of rules than the FHA regular mortgages. Different set of rules. We have no debt to income ratio, no credit score requirement. They can have almost no money and still qualify for the loan. But to answer your question, one of the requirements for this mortgage is it must be your primary home. You must live there. Now things happen. Let's just say initially, mom and son live in this house.
Right.
Things are fine. 6 months after, 6 years after they do this loan, mom has a fall. And by the way, they sometimes say, or many times they say, they break their hip, they fall, no, I'm sorry, they break their hip and then fall. People always say, I fell and broke my hip. A lot of times the hip breaks and then you fall.
This
Something-
is my exact
Yeah,
situation.
so let's say mom broke her hip and she winds up in a facility. Now, she's planning on coming home, right? We're all coming home.
Because they can't make you sell your house.
Basically they cannot, but there is a contract, there's terms. So if you're planning on returning, then it's still your primary home, just because you live somewhere else temporarily. I had a lady who bought an RV and went traveling for 11 months. Not even living there, she's living in the RV. But it's still her primary home. So the HUD rule says, if you're gone 365 days in a row, come on, it's not your house, right? You've moved. If you think you're gonna return home, then get yourself from the nursing home back to home, sleep in your bed, and reset that year. So you live within the rules.
Do you have to prove that?
It's honor system. They send you a letter, you gotta fill it out, send it back. Yes, I've lived here.
Thank you.
Yeah, it's gotta be your primary home. Now, some people will say, well, they've got a primary home in Pennsylvania and they're a snowbird in Florida, and they want to do a HECM for home purchase in Florida. They live in upstate somewhere for 7-8 months of the year, but they want to do the HECM in Florida. And they want to keep their homestead in that other state because they've had that house forever. The answer is yes. Yes, the answer is yes. HUD guideline says, what do you call your primary home? And if you say, well, I call Florida my home, I live there 4 months of the year, but I call it home, well, prove it. Where do you file your taxes? Where do you vote? Where do you have your car registered? Where do you have your homestead property? Where do you have your driver's license? Not all the above, but give me something that shows me your Florida home is your home. And I've had people that will get a Florida driver's license, get the loan closed, switch it back to Pennsylvania, and keep their homestead in Pennsylvania. And we're not committing mortgage fraud. We're following the guidelines. In this particular example, the lady had a Pennsylvania home with very high property taxes that she had homesteaded, and she did not want to change that because it would change her financial situation. So she was able to do the Florida home, not change anything except her driver's license. And then after the loan closes, she wanted a Pennsylvania driver's license, so she switched it back. No one checks on anything after that, and she still was living in Florida 4, 5, 6 months of the year, but whatever it was still what she called her primary home. And by the way, if anybody wants a copy of these slides, we'll get them to you. And same with this video. If you want a video, I'll send you a copy of the video.
I was just looking through the little FHA HECM refinance thing. Why are borrowers required to be 62 yet their spouse can be 18?
Yeah.
I mean, why not open this up to other folks? You know,
Because it
basically you need
relies,
money to do
it's
the
a throw
program.
of the dice.
Well, there's a very logical answer for that. Did I answer all the questions up to this point? Because I want to answer that.
Yeah, you probably have a lot of this in Margaritaville, but I'm just curious.
Yeah.
So
ahead.
the only other question is mom dies at day 360.
Oh yes, that was part B of the question.
What then
Okay.
happens to the house?
Okay, so I'll come back to your question because that's important. Okay, so we're using her example. Mom, 85, son living with her. That is not uncommon. The mom is doing the loan, not the son. The son's not married to mom. So your question was about a spouse. We'll come back to that. But mom is not married to her son. It's not his loan. Now he might be inheriting the house when she dies, but it's not his loan. When she dies or she's gone from the house permanently, the loan comes due. Now, if she's still alive in the nursing home and it's been determined that she's no longer living there, the HUD will give her up to a year to dispose of the house, which means that the son maybe qualifies for the loan, if he could, or maybe they put it up for sale and takes the cash and goes somewhere else with it. But the loan is not his. The loan has to be settled. Mom has to settle it. If she dies, then the son has upwards of a year. It's actually 3 months and 3 months and 3 months and 3 months for up to a year for the son to do something with the house, refinance it, sell it, whatever. There's no fire sale, but things got to move. You got to get the probate. You got to grieve over mom. You've got to list it for sale or refinance it. You got to do something because the loan is not the son's.
But the loan does, the old way of thinking, everyone assumes the bank just takes it.
Yeah.
Right, and I hear that so often.
So we're just paying off whatever she borrowed.
It's just a lien against the house. Going back earlier, a mortgage is a mortgage is a mortgage. It's no different. If I have a VA loan and I paid on my loan for 20 years and I die, my kids are going to have to pay off that VA loan. The difference between a regular mortgage is that kids have to make the mortgage payment while they're trying to sell the property. The HECM does not require any mortgage payments. They want a lump sum. They want the whole thing at one time, which means that there's no mortgage payments for the kids. Less of a burden to them. Many times, mom and dad will say, I don't want to be a burden to my children. Well, that's another reason to do this loan, because you're not going to burden them. They got to pay property taxes, homeowners insurance, HOA dues, but there's no mortgage payment while they're settling the loan.
So if the kid doesn't sell it in a year, then what?
So at the end of the
Do they
year,
foreclose on it?
yeah, at the end of the year, if the house has not been sold yet or not been refinanced, then HUD is going to say, are you really trying? Is it overpriced? What's going on, right? If you lower the price, anything will sell. So the kid's not trying to sell it, right? I mean, honestly. So then HUD says, look, we're going to start foreclosure. And then HUD will start foreclosure. So will any mortgage company. Remember, this is just a mortgage.
So let me ask you, and you probably covered it while I was writing, the difference between this one and a traditional mortgage is that mom dies, the heirs then either purchase the home or sell the home, during which time they have to continue making payments, and under this loan, they have up to a year and no payments.
Correct. Yep,
So
you've got
this
it.
would make better sense. I just wanna hear what happened.
Yeah, I mean, I'm a big believer that wherever there's a pro, there's a con. If there's a con, there's probably a pro. So let's get all the facts, and I'm a straight shooter. So let me just be negative just for a moment. The difference is that a lot of times, if a child inherits a house, maybe they did a quick claim before mom dies, and the son now has title of the house. If you don't really tell the lender, the regular lender, that mom died, a lot of times you can just keep making those payments and no one cares. Right? With the HECM, they're gonna know, and the loan's gonna come due. Social Security, HUD subscribes to the death list. When people die, there's a list, and they cross-reference it every week, every day probably. And if they see that mama died.
Under traditional, they don't even know, the heirs can just continue to pay for it?
Yeah, not with the HECM, but on regular mortgages. Now, if you read the contract, when the borrower dies, the loan comes due. But I've met so many people that are paying a mortgage for their spouse who died, or for their mom who died, or whatever. There's lots of those cases. So there, again, pros and cons. There's always pros and cons. But remember, or I shouldn't say remember because I haven't said it yet, but the most important person on the planet is you, is your clients, right? I love my kids, mom and dad, they probably love me, I love them, but what they have is their money, and what I have is my money. I'm a world traveler. I travel the world, I'm very blessed. And some people say, well, what about your kids? I've helped them a lot, and I want to see the world. I've been to all 50 states. I've been all over the world. I just got back from Australia a couple months ago, 3 weeks, it was a long time. Go ahead.
So in that same scenario, if 80-year-old mom dies and her 18-year-old spouse is in the house,
I'm
is
coming.
it the same scenario? Or?
No, it's better. All right.
Well, so how does that work?
I'm just going to graduate this guy and show him the door. No, that's one of the best questions. I'll give you a true story on this one. I didn't actually close the loan. And that's how I make my living. This is my volunteer stuff. I'm an education director. I'm the president of the HECM Association. But I'm a loan officer by trade. That's how I make my money, how I make my living. But let me give you the history first, and I'll answer your question. The history of that was back in the day when this program first came out, all the way up until 2000, not that it's that important, 2014, I think it was before, 2014, let's just say it was 2014. If the husband was 62 and above, I'm just gonna pick on the men because men are typically older than their wives. But let's say the husband is 62 and the wife is 60, right? That's a scenario. And maybe it's 88 versus a 61-year-old, but whatever it is, let's just say that the one of the spouses is not of 62 years old, and they wanted to do this loan. What we would do back then is we would take the younger person who's not 62 off of the title,
Right.
and do the loan for the older person. Now, men die sooner, statistically. Men are typically older than women, which means that there's a pretty darn good chance that the woman is going to outlive the man. What's wrong with that scenario? The man dies, the wife was never on title, she was on title, but we removed her, and she's not on the HECM.
She
The
had
loan
no place
comes
to-
due.
Yeah.
Now, she inherited the house, oh, that's great. But one thing I said before earlier, this is an age-based product. The older you are, the more you can borrow, which means now the wife is 62, she's eligible, except the husband was 82 and he borrowed more money, so the numbers don't work for her. She inherited the house, but doesn't qualify because there's not enough money to pay off the existing reverse, HECM, in order to do her own. This happened a lot. Talk about a bad reputation this loan got. When that happened, I always, as an ethical person, I always explained to the borrower what I just said. What is your plan? Well, I'm moving back to New York. Okay, well, that's your plan. Then look, we can do this. But if there's no plan, what would typically happen by an unethical loan officer, they would do the loan, pops would die, mama would say, well, what do I do now? and she's left homeless. She'd sell the house, she'd get $100,000, but what are you gonna do with that? Rent? And then run out of money in 8 years? So FHA in 2014, I'm pretty sure it's 2014, came out with this spousal protection and said, okay, tell you what, as long as you're legally married, so gay couples legally married, someone who is 72 married to a 25-year-old, true story, is legally married. As long as they're legally married, we will do this loan for both of them. However, pros and cons. It's going to be based on the youngest person's age. Right? So, true story, a 72-year-old, I love this story. A 72, I didn't do the loan. It didn't make sense, but we inquired about it. A 72-year-old guy lived in a condo in Tampa. And he called me up and said, I want to do this loan. I have a $200,000, because this is like 15 years ago. I have a $200,000 condo that's paid for, and my wife is 25. I met her when she was 22. I was vacationing in DR, the Dominican Republic. We fell in love. I brought her back. What's that?
Sugar daddy.
Yeah, and she probably had a past. But they fell in love, and sort of the funny part of this is she didn't speak any English and he didn't speak any DR. But they loved each other. This is a true story. You can't even make this stuff up. So they're now living in Tampa, and she says, you know, I want to protect my wife. So how much money can I get? Oh, it was like $25,000. And he's like, that's all? I said, yes, but there's no mortgage payment for the rest of her life. She's 25. She can live another 50, 60 years.
Right.
She has to pay condo dues, property taxes, but no mortgage payment. And they can get a $25,000 influx of cash right now. He didn't think it was a good deal. I don't think it's a good deal, but that's the offer. And yeah, but anyway, it's a great story. I got lots of stories. We could be here for hours. That's one of my favorites. Okay, so I answered your question, right? That's the reason that's there, is because it's to make sure that the spouse, no matter what her age is not displaced by this loan. It's a lifetime loan for the last remaining spouse. Okay, question.
Do you do anything with trusts?
Yeah, trusts are okay.
They're okay?
Yeah. If it's an irrevocable trust, then we have a little more work to do, and we may not be able to do it. But I have done an irrevocable trust, because an irrevocable trust is just that. You can't change it. So does the irrevocable trust have the proper wording in it to allow for the house to be mortgaged? Most time they don't. But if they do, and the one I did, then we were able to do the loan. But yes, we can do life estates, we can do trusts, we can do, we can't do
Ladybird?
Lady Bird, we can do that. What we cannot do is if mom decided to transfer the title to her property officially, not Lady Bird, to her 3 kids in order to try to avoid probate. Well, the 3 kids are not married to her and are not 62, so they have to come off at closing. But they can always go back on after closing. Right, if you read the contract, you're not supposed to do that, but no one checks the title. Anyways, question? No? Okay. Oh wait, let's just go back to that just for the fun of it. Another reason I want to get rid of the word reverse mortgage is because it's too generic. Right? A fruit, banana, lime, lemon, whatever you want to call strawberry, they're all fruits. They're all reverse mortgages. The FTC and CFPB, 2 federal agencies, only recognize 3 types of reverse mortgages. Generic word. Again, let's call a HECM a HECM. Home equity conversion mortgage, because that's the legal name that FHA calls it. It's like, I'm going to say it again. You're selling a strawberry, you have a strawberry stand, call it a strawberry stand, not a fruit stand, because you're selling strawberries. If you want to offer HECMs, talk about HECMs. So the FHA HECM is the federal government best and safest kind. The single purpose reverse mortgage is where the county, and every county in Florida does it, will defer, not eliminate, but defer property taxes to a senior if they qualify. Low income, the house could be worth a lot, but if they cannot afford, if they're low income and they're of a certain age, every county has different rules, that they will defer their property taxes for the rest of their life. Defer, which means that eventually it comes due. For the rest of their life, which means chances are whoever inherits the house, when the house is sold, the house is refinanced, the property taxes will be due. That's a reverse mortgage. So when someone says reverse mortgages are bad, well, what type are you talking about? Well, I don't know, all of them. All of them? Really? Are all fruits bad, including strawberries? No. What reverse mortgage are you talking about? The HECM? Because the federal government backs the FHA HECM. That's the safest loan in America. What do you mean? Then you have an opportunity to explain it. And then the proprietary ones, the third one, is basically a private lender, and there's tons of them, that follow FHA guidelines, still have the non-recourse feature, which we haven't talked about yet, and it's just as safe as FHA. Different set of rules, usually better, but not all, because there's pros and cons. But the third type of reverse mortgage is is the proprietary portfolio reverse mortgage. And we will get into that a little bit today. Question?
Did you say that there are different kind of reverse mortgage?
Yeah.
Yeah, there's the property tax deferral reverse mortgage. No one knows about that program, and it's really, if you're gonna do that, you might as well do a HECM, but it's there. Then you have the proprietary portfolio reverse mortgage and the FHA HECM. They're both called HECMs, but we're gonna talk about both of those today. Mostly we're gonna talk about the FHA version because that's the federal government program. But we are gonna talk about the portfolio reverse mortgage because it really fits where it fits, really nice.
So which is the one that everybody automatically thinks of when they
The
hear reverse?
FHA, the FHA HECM.
So that's the one that everybody automatically thinks of, is the horrible, do not do.
Yeah.
blah,
Yeah.
blah.
Yeah, that's the one. So up until recently, 96% of all HECMs were the FHA version. Today, it's 55% are FHA HECMs, 45% proprietary. And we're gonna talk about the proprietary, and you're gonna know right away why people are gravitating towards the proprietary ones. It's a great deal in a lot of areas, but it doesn't fit everybody. Just like nothing fits everybody. Not everyone should be a homeowner. Fair? Not everyone is responsible enough to be a homeowner. Okay. Or have the money. I mean, I've met people that they buy a home, they inherit money, they have all this cash, they buy a home, and then don't realize there's property taxes to pay.
Yeah.
Don't understand that they don't have to, but they should have homeowners insurance.
Right.
And they don't know about the homeowners association and why that's even important. I don't use the pool. Why am I paying a fee? Well, because if you don't, you're going to lose your house. Okay, so I like to use 65% down because it's good math. A 62-year-old is going to put a larger down payment, maybe 68%, or an 82 might put down 60% to purchase a home. And we're going to get into that just a little bit, but if we just sort of stick with 65%, then it'll get us a long ways. And remember, see, don't I have a pointer? Yes, I do. Look at that. No, I don't. Yes, I do. Oh, there it is. The most important thing is right there. Optional monthly mortgage payments for life. On the way over, I was reading an article while I was driving.
He's talking to you.
Yeah, I was actually looking for the button where it could read it to me, but obviously I couldn't read it because I was driving, but I did read a couple of words. It talked about how to handle objections when people think that this is an expensive loan. And we are going to talk about why people think this is an expensive loan. But the bottom line is, how can not have a monthly mortgage payment for the rest of your life be an expensive loan? When we pass on, there's no debt going with us. So what's expensive? The down payment, of course, but cash and cash flow is what's king. You're going to hear me say that over and over because I believe it. It's really what matters. In fact, I haven't even said a statistic in so many years, but I'm going to say it now because it just hit me. What is the biggest fear of our retirees?
Running out of money.
Wait, what about dying? No, it's running out of money.
Yeah.
You know, and there was a Seinfeld episode one time. It said, Jerry Seinfeld said that, forget the money for a moment. What is the biggest fear between these two? What is the biggest fear? Public speaking or dying? And public speaking. And Jerry Seinfeld's twist on it was, that means the person given the person given the eulogy would rather be in the coffin. Yeah, but number one is running out of money. It's the biggest fear. And I have met people of all ages, 62 worried, 90 worried. You never fear that because, you know, my mother-in-law has close to $100,000 in the bank, and she's a renter, by the way. Her husband never believed in home ownership, and now she's 85 years old and she still rents. And she's getting a good deal. She's paying $1,300 a month for a place that's worth about $2,000, but she's been there for 30 years as a renter. And of course, her rent was probably $200 a month back in the day. But even I've been married to my wife for 15 years, I think. But even back when we were dating, I said, you're old enough to do a HECM, you should do this. Oh no, I'll never buy a house. Biggest mistake in their life. But she's got $100,000 in the bank, and she pretends, it's probably a good thing, that she doesn't have any money. She is broke. She is poor, poor, poor. And she freaks out over money, money, money. She's 85.
Oh.
She's 85. Her mom lived
Don't
in
have
99.
lobster?
What's that?
You don't have a lobster.
Yeah, she won't do it. Oh, can't afford that. Can't afford that. She makes enough money to add about $200 a month to her savings account. So she's got a little bit of money. And she's got almost $100,000. And she is, I'm gonna watch up time. Oh, man, 10 minutes over. And she is where was I going with this?
She's worried about how much.
Yeah, her mom lived to 99 and 10 months.
Oh.
So fair enough. She could live another 15 years. She could. But she's scared to death. And she's also scared of banks. So she has her money in checking and savings account. And she doesn't, even though I'm a financial guy, I finally, just 6 months ago, convinced her, with the help of her daughters, to take her money from her savings account, making 1% interest, and put it into a CD at 3.75. All right, the difference is 3 or 4 times the money. She's getting $1,000 a year now worth of extra money, or $2,000, whatever that math is, of extra money. If she's worried about money, then put it in a CD. If you're not going to touch it, put it in a CD. Oh, but it locks up and I won't be able to touch it. You're not touching it anyway. All right, well, I am 10 minutes over, which means we are starting our 10-minute break. Let's be back at 10 minutes after 11, and we'll get this done. And by the way, we're only about 10%, so I'm joking. Started. Your job is to sell homes, right? Not sell loans. Now, if you have to throw in a loan in order to sell the house, okay, that's fine. Get someone pre-qualified. Whatever you have to do to get the home sold is your job. What I don't want you to do is be an expert at this. I'm not an expert at selling homes. If I need to refer somebody, I'll refer them to you. If you need to refer somebody, you can refer it to us, or our industry, and we'll help you sell the home, and we'll help you sell your home, whatever I'm trying to say. All right, and thank you all for coming. Appreciate it. Sorry. So one way to get the conversation started is have our association. We're a HECM association is 501c3 nonprofit. We can make these flyers for you at no charge. We'll brand it with your name and your phone number, email address. But this is how you get the conversation started. If you have open houses, put this on the counter.
I know.
And let people call you. And you don't have to be an expert at this. Just say, look, this is an amazing program. I attended this class. Let me put you in contact with an expert that can explain it to you and pre-qualify. And then you move on to sell the house, and let us handle this kind of stuff. And that's fair, right? And we can.
Why does this say? Sorry. Why does it say? Are you 55 or older? I thought it was 62.
62. Yeah, we haven't gotten to the 55 part yet.
Oh.
There's always good stuff coming.
Okay.
There's pros and cons with everything in life. I'm a big fan of understanding the good, the bad, and the ugly. And the bad part about the 55-year-old is the down payment is larger than a 62-year-old. Also, FHA does not do loans for 55-year-olds. They insure loans for 62, married to somebody who's younger, but the proprietary products start at 55. But there's pros and cons with everything, and we're going to discuss them briefly unless I run out of time. So here's what I like to use: 50% boost in purchasing power. I had a real estate agent tell me one time, well, I'm not allowed to ask someone their age discrimination. Well, guess what? We age discriminate all the time. The federal government requires us to age discriminate. So therefore, you have the right to say, look, I have special senior financing. What is your age? And maybe you qualify.
Well, it's criteria.
Right, it is.
It's criteria.
They don't qualify for this loan unless they're 55 or 62.
Criteria.
And so feel free to ask those questions, because there's a rhyme to your reason to do this. But the other thing is 65% sounds sort of complicated. Well, what about a 50% boost in purchasing power? It's the same math, just sort of in reverse. In other words, if we could find you the best home, your dream home, how much would you be able to come up with? If it was the best home in the world, the one you had to have, I could come up with 300,000. Well, half of 300,000, 50% is 150. So based on their age, and again, we're doing quick math, 150 plus 300 is 450,000. Now you know that you can go buy a $450,000 house, depending on their age, with a $300,000 down payment. And if they said I have 400,000, your number is 600,000, right? Half of 400 is 200. 200 plus 400 is 600. So it's just another way of looking at it. It might be easier to do it that way versus doing the math in reverse. Or maybe it's not, but you make that decision. So the FHA program starts at age 62. Again, the spouse can be of any age. The portfolio, the reason I changed it to portfolio, I didn't really change it, our industry changed it to portfolio, is because that sort of sounds wealthy. Proprietary sounds like predatory. We had a lot of predatory lending way back in the day, right? So whatever you want to call it, it's interchangeable. So when someone says I want to pay cash for my home, what they're really saying, I don't want a mortgage payment. Because no one really wants to give up all their cash. The number one fear of retirement is running out of money. Putting all their money into their house is running out of money. Paying cash for a house and leaving yourself with nothing left is running out of money. So don't let your clients do that. So the down payment is approximately 60 to 70%. I just cut in the middle, 65. It's just easy to remember. And you all have this brochure or something similar to it. And all these houses, by the way, it's all real stuff. These aren't made up properties. These are homes that are now sold, of course. But these were real estate agents that wanted us to do a brochure, so I picked out a couple of them. But that brochure on the big screen is the same brochure you have now, just different numbers. So I put this in here. I created this presentation 16 years ago, and I've tweaked it ever since. And this is one of the things that have been in this presentation the whole 16 years. But it sort of hits home. If every home in the state of Florida was on sale today and today only, 30% off, 40% off, how many of those could you sell? If you started calling all the people that you've ever spoken to that were thinking about buying a home in Florida and say, look, I got a special deal. Homes are 35% off, today and today only. And obviously, that's a rhetorical kind of a question, but today and today only, if I could show you something, would you be interested? Well, if it's on sale, sure. Tell me more about it. And that's just sort of a way to hit home, because that's what this program does. So let's talk about the non-recourse feature. I've been hinting on that for the last hour and 10 minutes. The non-recourse feature. For some reason, that's a foreign word, and I don't know why it's foreign. Non means no. Recourse means to strike. So no strike, non-recourse. In other words, your clients cannot be hurt by this loan. Well, what do you mean? It's a mortgage. Well, the way this program is set up, not only the proprietary, but also the FHA HECM, is that if there's ever a time that the house is worth less than what is owed, and you're done with the property, your clients are done, it's a lifetime loan, so they can live there forever no matter what the value of the house is. But what if one day they pass away, they needed to sell and move, and it's determined that what used to be a $300,000 house that's now worth $400,000, what used to be a $200,000 loan is now $500,000 loan. They're upside down, but now they're done with the house. They're hoping to leave it to their kids, but we're in a down economy, houses have plummeted, interest rates are high, whatever the reason is. If there's ever a time, regardless if it's a proprietary or FHA, that the house is worth less than what's owed, the borrowers have the right to hand the keys back and walk.
Wow.
And never owe a dime. There's no IRS hit, there's no deficiency judgment, there's no hit on the estate, there is no recourse. 0, 0, 0. And I'm going to answer your question, but what's more is that's for mom and dad. They cannot be hurt. But they also, the children or their heirs cannot be hurt. So the kids will have the option. Say mom and dad died, the kids inherit the house. If they want to keep the property, they can get a clear title for 95% of the current value.
95%
Of the current value. So let's say the value is $400,000, but the balance owed is $500,000. The house is only worth $400,000. What's owed is more. And the kids want the house. It's in Florida. It's always been the family home. They want that. The kids will get the right to get a clear title for 95% of the current value. So what is that? $380,000.
So they have to buy it.
Well, they inherit it by will, but they have a lien against it.
For 385.
For $380,000, they can get a clear title if they want it. Now, most kids don't want the house, but the point is they have the right to get a clear title for 95% of the value.
We still could refinance it.
So they can refinance it. And what's more, if a real estate agent's involved, they still get their commission.
Wow.
So FHA or the proprietary companies, there's a slush fund for this in case it happens again, because it did happen in 2008, 9, 10, 11. FHA charges an insurance fee for this protection. They have a very reasonable interest rate, but then they have a 0.5 point a year insurance fee plus an upfront fee. We'll discuss that in a moment. But all this money, which is hundreds of billions of dollars, is in a trust fund for when and if this happens again. FHA can reach in, take the money, make the lenders whole, make the borrowers whole, and no one gets hurt. The proprietary companies don't have the insurance fee, not the upfront or the ongoing, but they have a higher interest rate. Interest rate is anywhere from 8.5% to 9.5%. So it's built into that. Interest rates, you could say, are a little bit high, but it's a non-recourse loan and you don't have to make any payments. Again, pros and cons with everything we do in life. Question?
So, I understand, this is an option that they can choose when they.
It's built in.
It's built in, okay, then my next question is, if I recall correctly, this is the piece that people hated about the original reverse mortgage, is that correct?
It's always been a non-recourse loan since inception.
So,
People don't understand it, that's.
They don't understand. I tell you what they don't like. This is an expensive loan.
Right.
Well, let me tell you, it's not expensive, but
because of the fees that accumulate, correct?
well, there's two things that people, the misconception, everything's relevant, right? Good, bad, and ugly, right?
Right.
So the perception is expensive. Let me give you an example of how expensive this loan is. Now, in my opinion, no monthly payments makes it a cheap loan. But let's talk about how expensive it is. Now, first of all the fees are rolled into the loan, so it doesn't really come out of their pocket. If they live there the rest of their life, they're not paying it. Putting that aside, here's the fees to do a HECM, an FHA HECM. Proprietary is different, so we'll talk about that separately. But the FHA charges a 2% fee for the insurance of the appraised value. So a $500,000 purchase, FHA has a $10,000 insurance fee. It's financed into the loan, but it's $10,000 for the insurance fee to make this non-recourse. Then they have an annual percentage rate of 0.5 point. That's not a lot of money, but it adds up. Then you have your Florida closing costs, doc stamps, intangible tax, title insurance.
Which you would pay anyway.
You'd pay anyways. And so you have those two fees. Those fees, that's fees probably 1.5 points. So $10,000 for FHA and maybe $6,000 for closing costs. Now we're at $16,000. Then the lender charges a $6,000 origination fee, or it's a percentage, but on the high side is $6,000. So closing costs on a $500,000 house is $22,000.
Wow.
But the down payment we discussed earlier already includes the closing costs.
Wow.
So it's not in addition to that. What they have to pay for is the appraisal, home inspection if they want it, and the counseling requirement, telephone counseling. It's $150. So there's not too much money out of their pocket other than this large down payment. The proprietary program doesn't have that 2% insurance fee, but they charge a higher interest rate. So closing costs are lower. But when I hear people say, well, that's an expensive loan, compared to what? Compared to what? Not having a lifetime of mortgage payments sounds to me like a pretty cheap loan.
So, what are the, to be able to do this kind of loan, they have to carry homeowners insurance?
Yes.
What happens if they stop paying taxes? Is
So-
there any way that something,
I remember 15 years ago, headlines of Orlando Sentinel said, widower loses home due to reverse mortgage. There we go again. National, Orlando, more bad news. And of course, at that time I worked for Wells Fargo, and of course all the loan officers, oh my God, you see the headlines? It's reverse mortgages are bad. Well, did you read the article? Well, no, I read the headlines, because that's all people read. If you read the article, the lady lost her house because she didn't pay her property taxes. It had nothing to do with the HECM. Nothing to do with the
So
HECM.
you have to pay your property, and then do you have to have homeowners insurance?
Yes, any
Do you
mortgage.
have to always prove that you
Yeah.
have, every year you prove that you have homeowners insurance?
Well, when homeowners insurance is set up, the lost payee for any kind of a mortgage goes to the servicer. When the policy lapses, not getting paid, the servicer knows.
Oh.
So
okay.
automatically. So
Yeah.
homeowners insurance, homeowners association, and property taxes have to be paid. But that's with any mortgage.
Right, right.
Right. All right. I gotta keep moving. Raise your hand if you have a question. I'm gonna keep moving. Safest loan in America. All right. So when is this loan due? When they don't live there anymore. They've died, they've moved out permanently, or they're gone for 365 days. And that's for the last borrower. So this 25-year-old wife could be there for 50 or 60 more years. It's for the last borrower to be able to do this. I mean, before the loan is due.
Can you sell the house before you die?
Yes, you can sell the house at any time. There's no prepayment penalties. You just pay off the mortgage. Yeah, it's just that. There's no restrictions except it's got to be your primary
I
home.
thought you had to live in it till you.
Yeah.
So let's say an older homeowner who owns it free and clear and wants to get that reverse mortgage, but since they have owned the house for so long, maybe they have not taken so well care of it. Typically before a loan, especially if it's a FHA loan, everything has to be perfect. So is that the same here that you
Yeah.
have?
Does that, the house, she's asking, does the house
gotta-
have to qualify for
Yeah.
the loan?
So if it's a refinance, then we can use the funds from the HECM to repair the house within 6 months of closing.
Oh,
So, and a lot of times that happens. People do this because the roof is getting ready to be, replaced, or it's just in disrepair. So this is a way. So the FHA appraiser will look at it and say, the front door's got a crack in it, the front window's is broken, we gotta get that fixed, you got 6 months. And one more thing, if you're purchasing a HECM, the house has to be move-in ready, no repairs allowed, no escrow for
Oh.
repairs. So the seller or somebody has to fix it to make this house move-in ready for a purchase.
what happens if they don't have the money?
Well,
fix
they're
it?
buying the house, so they should have the money, or they wouldn't be buying the house. And if
No,
they're,
the
if they're
seller-
refinancing it, one second, I got her question, but if they're refinancing it, then they can do it from the money they get from the refinance.
They'll allow that.
Yeah. Question here?
Okay, when I see homes here that obviously the owners don't have the time, the money to really take well care of, the windows are old and everything is a little bit falling apart, but well, they are living close to the beach, so and probably they inherited or whatever. So would you say that they are the perfect client that we it might be a good idea to approach them and go and tell them about it?
So as a you're a real estate agent, you make your money by selling homes.
Yeah.
And helping people buy homes.
Yeah.
They may be better off to refinance, which means there's nothing in it for you. You can refer them in good conscience and say, look, I know a guy that can help you get some money and refinance. Or you could say, look, you've been in this house a long time. Wouldn't it be nicer to move into a 55 plus community where there's activities, and wouldn't it be better to move a little bit further away from the beach where you can get a nicer house? How about a brand new house as opposed to this one who is starting to need some old repairs? Wouldn't you like to have a bigger kitchen, a better bathroom? Then you got 2 sales. Now always do what's best for the customer, of course. You don't want to move them just because you're trying to make a sale, but if they're interested, then why not? Question? No? Okay. All right. And if I go too fast with these, just slow me down. Okay, so we've already talked about this. The borrower must be 62. The co-borrower can be any age. When it comes to the proprietary programs, they both must be 55 plus. They cannot be 45 and 55. That's private companies can do what they want to, and that's the rule. We do not have a credit score for the FHA. We do have a credit score for the proprietary. It's somewhere between 620 and 640 or better, and then the better the score, the easier the underwriting is. FHA doesn't care what their score is, but they do care if they're responsible enough to pay their bills on time. And if they're not, then they ask the question, well, what happened? Because life happens. I have a lady right now who has lung disease. She's been dealing with it for years. And finally, her medications got so expensive that she just gave up on the money.
Oh.
So she hasn't paid her credit card bills. And she doesn't owe a lot, but any amount means she's not paying her bills. Her credit score is shot down from super high number down to 611. Because it's a condo, she needs to do a proprietary one, which we haven't discussed that yet, but we will. And the credit score is 620. She's at 611. So I sent it to the lender yesterday and I said, what choices do we have? Write me a letter, prove to me that she's got a life event, this cancer or this lung disease, and we can make an exception. Okay. She's got the money to be able to afford to be there. She's got the money to pay her condo dues, her taxes, her groceries, but her credit score is just under what we need, but she has a life event, so we can make it happen. Okay, so as I mentioned before, we have duplexes, triplexes, quadplex, FHA condominiums. If anybody is involved with FHA and condos, you know they're difficult to get approved. So we have proprietary programs that'll take them all day long. Interest rates higher, but they take them all day long. You have single family homes, great. Leased land, a little bit of a challenge. Manufactured homes, yep, we can do those with the FHA, not the proprietary. And if it's a leased land condo, we have some questions, but we've done them before. So the quick answer is we can do any property. At least we can try. Most properties will qualify, and if we're not sure, let's just do some research. If it's on leased land, it's got to exceed the 150th birthday. It's got a perpetual lease. It's got to be annual renewable, but with the customer has to be able to renew it, not the landowner. Because wouldn't it be sad to do this loan and then the landowner says, I'm selling to a developer and you're out of here? So there has to be some safeguards for FHA. Okay, so down payment, where do they get the money? The key is you cannot borrow the money to borrow the money. It's got to be their own money. They can get it from their own accounts. They can sell assets. I had a customer sold their gold bars. Gold bars, they had serial numbers. He had a receipt from when he purchased them. He had a receipt when he sold them. We're able to use that money. A guy sold a car, had the money PayPal'd into his account. We could trace that back. So it's got to be his money, her money, to do the loan. I had a lady who wanted to borrow money from herself. She wanted to borrow money from her 401k. You cannot borrow money, not even from yourself. It's got to be a cash out. I had a gentleman that cashed out his life insurance. Got the money to do what he wanted to do with. Gifts. Now, those of you that say FHA doesn't allow this, well, guess what? FHA HECMs allow gifts from friends. Now, you got to prove they're your friend. Could be a Facebook friend going back 5 years. It could be, elementary school picture from your, school days. But other than that, yeah, I had a customer who gave their friend $50,000 and he bought a house in the Villages. He got a gift from his friend for $50,000. Now, you and I both know that there was some kind of a side deal, but I know nothing about that. No, there was. Okay. What's not allowed is you can't borrow the money. You cannot get any kind of subordinate financing. So in other words, you can't go get a first-time home buyer grant. You cannot have any kind of subordinate financing. There's going to be no strings attached to anything that goes along with this house, because FHA or the proprietary loan will be in first lien position and second lien position. This is most of these are HUD insured loans, which means HUD is going to be in second lien position in case the lender were to fail or the house goes down in value. HUD wants to protect everybody. So a person cannot do this loan, first lien, second loan, and then go out and get a HELOC or any kind of third place financing. Not allowed. Now, if they can get third place financing, more power to them, but no one's going to do that. Okay, I'm going a little bit faster because, Anyway, so how much does the borrower have to come up with? Well, the down payment plus approximately $600, $650, within that range for the appraisal, FHA appraisal. And then right now they're running $575. Why they're cheaper, I don't know, but that's what they used to be. And then both these types of HECMs require telephone counseling. It's almost like an insurance policy to make sure that the borrower understands their obligations. Got to pay taxes, got to pay insurance, HOA, got to maintain the house, no required payments. You can sell at any time.
So with a live person?
With a live person over the phone, if you call them up, they're going to tell you it takes an hour, but 30 minutes. It's going to cost you $150, $145 in most cases.
And the house has to be in good enough condition that it can be appraised.
Well, a refinance can be almost any condition. If the repairs exceed 15% of the value of the house, then FHA is going to reject it, but
So it doesn't.
most houses aren't that bad. So if we get estimates, let's just say the windows need to be replaced. I mean, they're cracking and there's holes, there's cracks along the edges, or maybe it's a pre-78 house and it's got peeling paint. we have 6 months to fix certain things. If it's a brand new, or if it's a purchase, the house has to be move-in ready. And to give you a strong example, I had a seller who flipped the house, but didn't replace the toilet, it had a crack in it. It's a crack in a toilet, who cares? The seller refused to do any more work to the house. As is, take it or leave it. Well, we couldn't do the financing, had a crack in the toilet. Fortunately, the buyer had enough skills and went and replaced it himself, with the seller's permission, and we had a closing. I had a customer that, when they were leaving, they took the shower head off the shower because they wanted it. Then the appraiser went out and said, it's missing a shower head. We had to put the shower head back on, a different shower head, in order to close the loan, because there could be no repairs for a purchase. All right, we'll go back to that. So here's what we talked about before, is you have your normal closing costs, you have your FHA PMI, we call it MIP, same thing, just in reverse. 2% of the purchase price, not the loan amount, and portfolio loans don't have that fee. And then the origination fee is up to $6,000. It's as low as $2,500. That's what the lender gets for all their work and commissions. Up to $6,000 max. Now this is pretty cool right here. Is $1.2 million. The proprietary loans do not have a limit. You can sell a $10 million and $15 million home with the proprietary. Good, bad, ugly. Good in this case. FHA caps it at $1.249 million. Doesn't mean you can't sell a $1.5 or $2 million house with an FHA loan. It just means that FHA is going to consider the value to be $1.2 million when they do the calculation, the 65%. Anything above the $1.249 million is paid dollar for dollar.
Oh,
So you can still do it,
right.
except their
But you
down
can
payment
pay
will
the
be larger.
difference.
Right. So what we would do for your client is we would show them both programs. The FHA, here's your down payment. The proprietary, here's your down payment. And if you look at your handout, the one that says 1 point something million, that's a proprietary proposal. $1 million down gets them a $1.7 million house. That's not an FHA loan. And imagine that. Someone comes to you and says, I've got $1 million cash, sell me a house. It's a good day. Except the neighborhood you take them to
It's 2 million.
is 2 million, 1.7 million. But wait, there's more, right? So this is money. This creates money.
Right.
Go ahead.
Why is there a 2% PMI requirement when you have such a substantial
Down
amount
payment.
of money down? Generally, if you have 20% equity
Yeah.
in your home, there's no PMI.
Because it's a rising debt loan. Because there's no payments. It's an insurance policy. Because
That's- on that $1 million example, there's 20,000
Yeah.
plus per year.
No,
Yeah.
one time.
No
It-
PMI is every year.
No.
it's one time.
One time then.
it's a one-time.
Oh.
It's a one-time 2%. I'm glad you're listening. One-time
Okay.
2%. Then there's a half a point a year based on the loan amount, not the value of the
This
house.
would be 5,000 plus, okay.
Yeah, so yeah, 5,000, well, no, less than that, because they're only borrowing 700,000. So 3,500 a year in additional PMI, MIP.
Yeah, okay.
So, and people ask me that all the time. Well, that doesn't make sense. I'm putting more than 20% down. Remember, the regular FHA financing is different than the HECM financing. It's under the FHA umbrella, but it's a different set of rules. We don't have a debt to income ratio. For example, if your client has $10,000 a month in income, right, they're doing well in retirement, but they live large. Their Cadillac, their Ferrari, and everything else they do comes out to $9,000 a month in expenses. You are not going to finance them with any kind of conventional loan, right? Their debt to income is way over. But with the HECM, we only need $529 a month left over after paying all their bills for them to buy groceries, and they qualify. $529 for a single, $886 for a couple. So they would qualify. As long as they have they've been paying their bills on
I'll
time.
just call you
Right.
and you can explain it.
Yeah, it's too much information, but we can pretty much qualify almost anybody for this program, even with people that are above the 41% debt to income ratio. If they've got enough money to pay their bills on time and have enough money for groceries, we're going to look at their credit report to see what their bills show up. Then we're going to look at their property taxes, their homeowners insurance, their HOA. We're going to add it all together. As long as they have $529 a month left over to buy groceries, they qualify. at least financially, income-wise. Okay. Okay, we got about 20 minutes. All right, I'm not gonna get into this, but I do want to stress the fact that this is truly financial planning.
Yeah.
So many people will say, well, if you ever want to go broke, you do a HECM. Go do a reverse mortgage because you're going to lose all your money. No, on the contrary. You know, we talked about cash and cash flow. Well, what about the duplex, the triplex? You can actually increase your net worth. You are increasing your net worth because of home equity increasing. You're keeping your cash to enjoy life. I want to leave my kids something. Well, then start saving some money for your kids. Help your kids buy a house now. Help your grandkids through college. Buy life insurance so they get a death benefit when you die. Enjoy life. If you use this, for example, currently under current law, if you're 62 years old, you can draw Social Security. The problem with drawing Social Security and you're still working, your tax rate is upwards of 50%, 50, of your Social Security benefits. You could actually get a tax bill at the end of the year because you made too much money.
Yeah.
Now, hopefully the current administration is going to change that, but what if you said, you know, I could use the money right now, I'm 62. I'm a realtor and I make commissions when I make commissions, and then in between my commissions, I could use a little bit of money. So I'm going to draw Social Security. And then you make a big sale. Oh, then you got to pay it back. What if you were to do a HECM and do a HECM instead of Social Security? Because the money that comes from your line of credit is tax-free. Money coming from Social Security could be taxable. So what if you delayed your Social Security and get an 8% increase in your Social Security benefits every year? You're still working, so you're still paying into it, but live off your HECM. And then when you're of age, 65, 67, then you can start paying the HECM back if that's what you want to do. Now your Social Security check is larger than it would have been at 62, and now you can make as much money as you want to make without being taxed at an outrageous amount. And my age is 67 for me to have full retirement. And some people is 66, 65. So you can check with Social Security Administration on that. Anyways, we're not gonna get into all that, but there's slide after slide on how that works. When CFPs, Certified Financial Planners, understand the HECM, they embrace it. In fact, the FINRA, I'm pretty sure it's FINRA, announced to their financial planners, certified financial planners, the only way to make a financial plan last to the age of 95, which is the new standard, when you sit down with a financial planner, they want your financial portfolio to last to age 95. What if you went to a nursing home? What if there was a bond market crash? What if the stock market crashed? What if there's 10,000 different ways they come up with? What if your spouse dies too young? What if you die too young? How can we make your family financial plan last to 95? It's been proven time and time again that home equity must be involved in your financial plan. Not saying that HECMs have to be, but home equity must be included, whether it be a HELOC from your local bank, or you get a regular mortgage from your local bank, or whatever it is, but home equity must be included or your financial plan is not going to make it to 95. And that's what these slides are about. So we'll skip over all this.
Is there,
I'm sorry, go ahead.
is there a formula where you can say, okay, if your, let's say your home equity is so and so much or in percentage to your living costs, that you can say, okay, basically now I have enough that I can switch and I do this and I live for the rest of my life.
Yeah, that's what he's saying, that there is.
I'm gonna be a little bit different than her. And I'm sorry?
I was asking, is there like a formula where you can say, if
There-
this is the amount, then you can say, now I don't need to work anymore.
Well, I'm gonna say no, and the reason I'm gonna say no is because, here's why. If you had $5 million in investments, and let's make it even easier, liquid investments, stocks, bonds, right? Not real estate, because real estate you gotta sell. Let's say you had $5 million in liquid investments, meaning stocks, bonds. You could sell it within a couple of days. Do you have enough money? The quick answer
I
is
would think so.
you would think so. The quick answer is yes. But the problem is no. What is your lifestyle? What kind of toys do you have? And then how long ago did you buy those assets? And if you were to sell them now, what would be the capital gains? What would be the financial cost? One thing that people should not do is cash in their assets because there's too many consequences. And same with real estate. If you have a bunch of real estate, When do you sell that, and how long is it gonna take you to sell it to get the money? Wouldn't it be better if there was a line of credit, something that you could reach in and just grab 100,000 like that does not have tax consequences? And this is how you do it. So some people say rich people don't need to do this, and I disagree.
Yeah.
I think people of any wealth, obviously it's more magnified if your net worth is $50,000 and you still have a mortgage on your house, it's magnified. But if you have $10 million, yeah, you probably need this, because again, it's part of financial planning. So to answer your question, I don't think that there's a formula, and the reason is because financial planners have this system called Monte Carlo, or gambling. And I've never been a financial planner, but if they sit down with you and your husband and they enter all your vital statistics, your paychecks, your sales, your net worth, all the investments that you have, just list everything. Your family history of medical, are you gonna wind up in a nursing home? How about your husband? Is he gonna die early? Right? Just enter everything that you can possibly enter and then hit the button. 10,000 different scenarios happen. And all this data comes out. And they're trying to make your financial plan last to 95. And what if you died on the way home today? What is your husband gonna do? It's gonna change everything. And if you both lived 100, well, that's gonna change some things too. So there is no magical answer to that. You just gotta sit down and run the scenario. And home equity must be included. It must be, or it won't work. All right, let's move on. So what's next? So when you come across a prospect, somebody that's 55 plus, 62 plus, and this is of interest for your particular transaction, let's talk about it. You know, let's refer them over to an educator, myself or somebody in the industry, and let's see if it's even an option. Again, I'm a big fan of good, bad, ugly. There's always pros and cons. So rather than shut it down and say it's all bad, well, maybe they're not interested in a 9.5% mortgage. It's a lot of money. Then again, maybe they are, because it makes sense for their situation. And some people are okay with a 2% FHA fee in order to have the interest rate lower. And some of my clients want to make a monthly payment. In fact, I haven't discussed this yet, so now let me do it now. The FHA program, and most of these, by the way, are adjustable rate mortgages. There is some that are fixed, but most of them are better if they're adjustable rate. And they're always tied to something like a treasury bill, so it's always consistent. But we would discuss that. But the FHA program, are you sitting down? If your clients decide to make a mortgage payment, it pays down the principal.
Okay.
However, the exact amount of money that's paid to pay down the principal is added to the line of credit and can be reborrowed at any time at no charge.
Wow.
At no charge.
Wow.
So think about this. Your client says, you know, I'm not doing this because I want to make mortgage payments. And then the spouse dies a year later. Wish I didn't have to make mortgage payments. Well, too bad. You got 30 years, 29 more years. What if they did this with the full intentions of making mortgage payments? And so they do. They pay $1,000 a month, every month, and they're happy with that, and life goes on. 10 years later, they've made $120,000 in mortgage payments, and then life happens. Maybe they just change their mind. You know, we've always wanted that round-the-world cruise, and we have never done it. They can call their servicer, and every dime that they paid in is fully refundable, no charge.
Wow.
Free. And are you still sitting down? The FHA version, again, there's pros and cons. The FHA has all sorts of really nice pros. Any money that sits in the line of credit is going to grow at about 6.5%. So if you have $100,000 in your line of credit, the next year you have $106,500 worth of additional money to spend. And next year you have $113,000, $119,000. It compounds at approximately, it's an adjustable rate, but it's always going to be in that range based on the treasury bill plus a margin. So you're paying down your mortgage balance, which is saving 6.5% of interest, and you're growing 6.5%, so that's a 13%. We talk about financial planning. It really bugs me when someone says, my financial planner says I don't need to do this. Oh, maybe your financial planner needs to learn a little bit more about HECMs.
How long does it take to close on a HECM if you already own the home and it's free and clear?
It's about 4 weeks.
4 weeks?
Yeah, 4 weeks is usually sufficient.
Can you do
And same with purchases.
can you do a home equity line at the same time, like in the same 4 weeks, or do you have to wait till closing to start that?
So remember, all HECMs have 2 mortgages, first and second.
Right.
So you can't,
Well, I didn't mean home equity line, whatever you were saying.
oh, it's built
line
in.
of credit,
It's built in.
it's already.
It's all built in, yeah.
Okay.
It's all part of the same loan.
Okay.
Yeah, it's automatic. So, and that works for purchases and refinances. So refinances, a person they have a $500,000 house completely paid for. They don't even need the money right now. They're just planning for the future. So based on their age, they're able to pull out $200,000, but they don't want the money. They leave it in there, growing at 6.5%. So next year they have $213,000. They still don't want the money. So next year they have $226,000 in a line of credit. I just turned 60. Things happen.
It only gets worse.
Does it? So where was it going with this? Your line of credit.
You're getting interest every
Yeah, it's
single
called
year.
growth. It's not interest because interest is taxable. So it's called growth. It's more spendable money.
Oh, that's even better.
But my statement was going to be that when they're given the money, they have the option of taking it all. They could take some of it. Give me $10,000. I want to put a down payment on a car. Leave the rest for later. They could turn that into an income stream, like Social Security. If you could just send me $1,000 a month for the next 25 years, I'd be happy. They can do anything they want to. Whatever is in the line of credit is not being charged interest. Anything that's being taken would be charged interest. And any money that's sitting in the line of credit that's not being charged interest is growing at the same rate that it's being charged. So it's about a double spread. Go ahead.
One quick question on that. Does it matter if your primary residence is an LLC?
Oh, good question.
So it's possible, but the problem is you have to own it, so they would have to tie it back to that person. It's sort of like a trust, an LLC is sort of like a trust, but a little bit different. So chances are no, it's going to be up to the underwriter and how the LLC is worded, but chances are they're going to have to, at that situation, they're probably going to have to put that into a trust. And if the LLC is needed for whatever reason, there's probably a way to marry those two. Yeah, the quick answer is that they've got to own the house. Okay, so once we've pre-qualified your clients, then go shopping. Or go shopping first, but we need to get them pre-qualified. We need to make sure they have the right income, the right credit, the right payment history, and if they've got some hiccups, then let's talk about it. Because in my world, there's life events every day. A lot of times people wait too long and then, yeah. So I've already discussed the income requirements. They cannot be delinquent on federal debt. The federal government does not like to loan money to people that have defaulted on them. So student loans, yes, seniors go back to school and seniors co-sign for their kids and grandkids. If it's defaulted, see, payments are okay, but if it's defaulted, they gotta get that fixed. And how do you get it fixed? Well, you start making payments. You get a loan agreement, a payment agreement, and make it current again. And then we're okay. I've had people that defaulted on an FHA loan, I think it's within the last 3 years, and FHA is like, no, we're not gonna help you there. So, and that's pretty rare, but it happens. Okay, so sales contract. Now we are different, so we don't have TRID, we don't use settlement disclosures, we have HUD ones. We're a different program, and that's good and bad. It's different. When it comes to title companies, that's probably the next screen. I would highly recommend that you allow the lender to choose a title company because things are different. We're not going to lose a deal over a title company, and I know we all have favorite title companies, and I know the seller gets to choose the title company, and they're not going to pay for the buyer's title policy unless I get to choose my title company. But you know, like I know, the seller doesn't care who the title company is, right? The seller's agent does. Not going to lose a deal over a title company, but if we can let the lender choose, the loan will close smoother and faster. 6% in seller concessions, that's only been around for a couple of years. We used to have trouble with builders because builders always want to give you free stuff. We couldn't take them. And we lost deals on the loan side because we couldn't accept seller concessions, but now we can. And that's a world of help for us. We don't require home inspections, but obviously it's a good idea. Contingency must be there. There's a couple of FHA forms, real estate certification clause, some other basic stuff, but pretty much it's the same paperwork. Addendums, right? We love addendums. My point is don't be afraid. The most important thing is to get everyone's signature, right? Get this contract signed. If we miss something, we'll just do an addendum. And one of the things that's missed is people forget that this is an FHA loan if you do the FHA version, so you don't check off FHA. Oh, we'll fix it. No big deal. Just fill out the contract. Just fill it out. Get everyone to sign it. Let's get it done. And if we find something wrong, we'll just do an addendum.
So you use a normal FHA rider with it?
Yeah, there's two riders for the FHA. There's the real estate certification, which basically says the appraised value is what the number we're going to use,
Yeah.
or the contract price, whichever is lower,
Yeah.
and then the FHA amenatory clause.
I think both are on our.
Yeah, so we have those forms. If you don't have them, I'm going to delete this slide because it doesn't matter. It's just fun fact. It just seems like 72 seems to be the middle age. But I've got customers. My oldest customer was 96. One of my employees' customer was 106. My youngest customer, I think, was 49. Obviously married to someone older. And but yeah, that's just fun fact. Anyways, I guess the reason I have it in there is I've had realtors tell me, yeah, but I don't sell to seniors. Most of my customers are young. Well, that's fine. But 35% of every home that was sold in the state of Florida last year was sold to someone 62 and above.
Wow.
Not saying that you shouldn't go after millennials, but if 35% of the population is buying homes that are 62 and above, and 24% of the population are 62 and above in the state of Florida. If you go to Hernando County, which is Tampa, 65% of the people that live there are 62 and above. If you go to the villages, 100%. All right. And I'm going to delete this slide too. I put this in here back when our lending limit, when I started in the business, our lending limit, that 1.249 million, when I started 26 years ago, the lending limit was 115,000,
Wow.
which means that the average home in the state of Florida was 115,000. You could build a pretty nice house. You could buy a pretty nice house. And it crept up over the years, and it hit 417,000 for a long time. And then during COVID, it started going up fast, and now we're at 1.49 million. So I put that in there because I thought it was really cool, but I'm gonna take it off. Plus, Austin Power was popular at the time. I saw a commercial, Austin Power commercial the other day. You saw it, Amazon?
All of them, yeah.
Yeah, all right, and it's 5 minutes till. Okay, I'm gonna do this screen and skip over the rest. There's 13,000 people turning 62 every single day in the state, in the United States. Baby boomers, every day. And my joke is that they're all moving to Florida.
They are.
Up until recently, 1,000 people a day were moving to Florida, of all ages. That number's come down a little bit, but it's pretty close to that. 24% of the home buying population in Florida, meaning they're 62 and above. 35% of home sales last year was sold to seniors. 40% of the population, age 60 plus, are planning on moving to Florida. Well, that's a joke too, but still. People are planning on moving in retirement. That leaves us a lot of opportunities. 77% of the nation's wealth is being transferred.
Oh yeah.
Seniors have money. I've had realtors tell me, yeah, all my customers pay cash. Good, because that's what we need. If someone wants to put 20% down, they're not my customer. I need 65% down. Yeah, and how many times do people come to you and have all this cash, but not enough? Not enough cash. 86% of seniors want to age in their own home. Think about older homes, think about two-story homes, think about old homes in older neighborhoods that have just deteriorated. They want to be safer. If anybody's familiar with Orlando, just west of downtown is an area called Pine Hills.
Yeah.
Oh, I'm sorry, Crime Hills.
Yes.
And I remember this one lady I did a loan for years and years ago, but I remember her well because I'd visit her a lot. She's very needy, but I have a big heart. And she would tell me every time I come over, there was another shooting last night. I heard gunshots. She couldn't move. She just didn't have enough money. But there's a good client right there. Wouldn't it be nice if there was more money involved, that a realtor could get her listing and move her over to another section of town where she could be safer? her big fear was a bullet coming through her window. You know, and no one would find her until, well, she wouldn't call me, because, anyways. I mean, it could be a week or two before anybody found her. So she lived alone. It's very sad. And this is pretty cool too. AARP did a study probably a dozen years ago, determined that 96% of the million-plus people that have done a HECM, obviously their survey percentage was a lot smaller than that, but 96% of the people that did a HECM loved it, completely satisfied. And if you do that in a star, 5 stars, that's like 4.8 stars out of 5. And how many times do you have reverse mortgages? Don't do it. Don't do it. Well, I hear that from the freaking kids. Kids will, by the way, 19 out of 20 kids support the program when they understand it. But I shake my head because how many times, I talk to my kids, they said I should stay away. Well, allow me to talk to your kids. You know, knowledge is power. No, they're not going to talk to you. Wait, your kids are making a financial decision that's going to affect the rest of your life. Don't you think this is important enough to let your kids talk to a professional, an expert, and look at both sides and then make an educated decision? Yeah, they won't talk to you.
What are the 4% saying that don't?
I don't know.
There's gotta be.
Well, I remember this one lady. I don't really know how to answer that other than my own experience. I remember this one lady that back in the day we had a fixed rate was pretty common. It's not so common right now. But she had a 5% fixed rate. And this is at least 10 years ago, at least. And I remember visiting her years later, and she was not happy with her loan. She says, I get my monthly statement, and my interest is accumulating by whatever that number was, $500 a month. That's a lot of money. I said, yeah, but eventually all my equity is going to be used up. I said, well, your home is increasing in value. You never get to see what your house is currently worth. So are you losing money? Yeah, I'm losing $6,000 a year. I said, but you're not making a mortgage payment. No, which means that you're saving $6,000 a year that you're not spending on mortgage. Does that help you? Well, yeah, it helps me. I said, so if you're really concerned about the $500 a month, then just write them a check. And then it becomes a regular mortgage. Oh. But, so I made her happy by the time I left there, but the point is that she was unhappy because she looks at this mortgage statement and thinks that she's losing money. In reality, her money stays in the bank and her house is increasing in value. So I think it comes down to ignorance. Education.
The biggest negative? What is the biggest negative to this?
The biggest negative is it always stems back to the unknown. This is an expensive loan to get into. Okay, I'll give them that. But what about all the things that make it inexpensive? No mortgage payments. Buying a nicer house than you would otherwise have. I believe that I can handle any objection, but to answer your question, what are the negatives? It's an adjustable rate in most cases, nothing wrong with that. Expensive closing costs, the FHA insurance fee. I feel like I'm trapped in my home, even though they're not. I'm gonna owe more than I did last year because I'm not making a payment. I can handle all those objections, right? But those are the things I hear. I eventually will lose my house. My kids won't inherit anything.
That's the one that I hear over and over again.
Yeah.
My kids won't inherit anything.
Right. I hear that all the time too.
And how do you handle that objection?
The kid, well, first of all, it's completely false because a mortgage is a mortgage is a mortgage.
Because you still have the opportunity to repay, refinance.
Right, so one thing, a lot of the people in my industry still say this, there's no mortgage payments. There's no more monthly mortgage payments, right? I hear that all the time. So the reason I never use those words, there's no required mortgage payments, is because it's your decision, your client's decision, to make a mortgage payment. And if you decide not to make a mortgage payment, well, that's your decision to have the balance increase every month. That's how I handle that objection. Well, that's your decision. We're going to send you a monthly statement.
As is with any type of loan.
Right.
It's the same thing.
Yeah. So this is just a mortgage. And that's the reason I started off this whole presentation. This is a mortgage is a mortgage is a mortgage. All the things that people say are the same things as a regular mortgage, except payments are optional.
Oh. Why wouldn't everybody do this?
Look at this. Look at this. She's going to try to kick me out of here.
You're good.
Well, we've all agreed that we're going to stay one more hour. All right, I think we're done. So, why should we target the senior market is because there's all sorts of, seniors, socialize with seniors, and when you get one senior that's happy, all their friends are happy. I'm gonna go through this real fast and then we'll wrap it up. Moving into a better home, a maintenance-free lifestyle is always good. Sell one home, one large down payment. This is something you can put on MLS. You can't put specific things about a loan in MLS, but you can do something very generic. One large down payment, and the home is yours. Increases call volumes. What if a 30-year-old calls you about this? What do you mean one large down payment? Well, you can't do a HECM, but let me put you in contact with another loan officer and I'll help you buy that house. That's all you care about, right? Get the phone to ring. Moving on. Oh, and some people will do the HECM to pull out cash to buy a rental property, which will get them more cash flow. And then they have no mortgage on their primary home. Increase wealth. Always do the right by your client. Be ethical. There's all sorts of loan programs out there. HECM is just one. That. What do people do with extra cash? Help your family. Go remodel your home. Nicer kitchen, nicer bathroom. Take a vacation. I had a husband and wife. Boyfriend, girlfriend, had their own homes. The boyfriend, girlfriend, which means they did their own HECMs, and did a 120-day cruise around the world.
Actually, you can give kids their inheritance now
Yeah.
instead of
Sure.
waiting until you die and give them the house.
Make it a legacy instead of a death benefit. Exactly
You can
right.
use it now.
Yep. And we'd like to help our seniors. And this is just to sort of hit home. If someone comes to you and says, I've got $5 million, sell me a home, they really want the $7.5 million house. And we can do it. $10 million down, $15 million house. We can do it.
Needs just fun.
All right, and that's it. We're good. We're good.